indicator to comparing marketing efforts could be the amount of sales. For example, if the amount of sales in previous year was X and in the current year it's X plus one, this is indicating a better marketing control. Other aspects could be brand research, market share value, etc. The third one is human resource control. An indicator to assess HR control could be monitoring absenteeism. Absenteeism basically means that people are absent from their work and disappearing without notice. Increased absenteeism means that there's a need to monitor and bring control so that it can go low. The possible reasons could be dissatisfaction with the job and the people they're working with, working hours, etc. The fourth one is financial control. This is the most important, the most significant key feature to control and monitor performance of an organization and take corrective measures. It can be done through analysis of financial statements of a company like profit and loss account, balance sheet. Ratio analysis technique is another important indicator of financial control, which is performed on data available on financial statements. Under financial control, we come to types of ratios. Number one is profitability ratios. It suggests the ability of an organization of getting maximum return on investment. An ideal ratio is greater than 10. The second one is solvency or liquidity ratio. It suggests the ability of an organization to liquefy its assets as and when the need arises, as and when it is required. The third one is activity ratios. This ratio helps in measuring the ability of an organization to convert its inventory into sales. And the fourth one is leverage ratio. It suggests the amount of a debt a company is holding at a given point of time. It should not be a lot. It should not be high. All these ratios are measured to judge or analyze or assess and understand the financial performance, and they're also related to production, marketing, and HR performance of an organization. And they also control the parameters so as to work against and correct the negative deviations and analyze the positive deviations as well. After this, sir explained a few examples. Number one of which was that he said that, for example, he made a sale of rupees 100 and so did ma'am. But in his case, the unit cost was rupees 95 and the profit was rupees 5, while ma'am made a profit of rupees 10 and her cost of production was rupees 90. This example was given to help us understand basically profitability ratios, how they work. Despite the amount of sales being rupees 100 for both, one is making a profit of 5% and the other one is making a profit of 10%. The reason could be that there might be some expenses which we do not account or which are not accounted. For example, like tax and stuff. Uh, for example, sir had to borrow the money to make the product, and that affected, and there was a lot of barriers and taxes that he had to pay, because of which his profit was affected. So there can be a lot of things that we need to calculate, and which might bring us a lesser profit. The last topic revolved around return on investment. It means basically the assets, they should be productively used. They should not be overutilized. There needs to be a balance. For example, if we have rupees 100 and we are able to get a return of 10, then we should not increase that return directly to 35 rupees. This might not necessarily be healthy for our company. Sometimes when we focus too much on investments or on overutilizing our assets, it might create a problem for us. This is what happened in the case of Bhopal gas tragedy, which primarily occurred because of heavy emphasis on ROI. They were given the brief that they had to squeeze their assets, and in order to do so, they compromised on preventive maintenance, necessary refurbishing investments that were required at that moment. And that lead to machine malfunctioning and the leakage of methyl isocyanate in Union Carbide pesticides factory, which led to the deaths or killings of and casualties being in millions and thousands, I think. And that is one of the worst industrial disaster India's ever seen. Therefore, it's said to have a good balance in between your ROI and everything. Then sir requoted his teacher. It goes on like, and business earning an ROI of more than 20% is inherently unsustainable. A business should be steady and consistent. So there should be a good balance. He concluded with that having the knowledge of concept is good, but we need to have an understanding of those concepts to a practical level. It will be good practice to refer to balance sheets in PN, statements of various organizations. All these documents, all these information are in public domain, and hence And whenever we are joining a summer training organization, we must make sure to study their balance sheet carefully, which will give us an idea if the organization is financially stable or not. And we can also this can also be studied through the measure of different ratios which we discussed today, which were discussed yesterday. If we have idea and we study different ratios and financial statements of various companies, it will help us make wiser choices. That will be all. That was all taught yesterday. Thank you.
Thank you, Anas. Now, Ahmad.
Yes, sir. So is my screen visible?
Yes.
Okay.
The screen is not visible. You are visible, but
Screen is not visible. Sir, is it visible now?
yes, now it is visible.
So shall I start?
Please.
Good morning, sir, ma'am, and all present. Yesterday's class revolved around the topic controlling. These are the controls that may be used to monitor and check the performance of an organization. The operations of an organization may be classified into an 80-20 ratio, in which 80% of activities being minor and requiring less oversight, while the 20% being critical in nature and responsible for bringing in the majority of companies' output. Too much controlling, too much controlling can lead to negative outcomes. So we should only concentrate on the key areas that contribute to the majority of the output. Instead, an organization should try to practice value settings where where one should not only try to control activities but also on instilling control in ourselves and our employees. Moving to the next slide, Stephen Covey, an author and a businessman, said, advised that we should aim for the four L's when it comes to self control. The first is live. How can we spend our lives? The second is learn. How can we learn? Via what activities can we learn so that our learnings are long lasting and valuable? Self love, work love, and other love. How can we love ourselves? How can we love our work and others? Leaving a legacy. How can we execute our work in such a way that allows us to set an example for others and leave a legacy? Coming to the next slide, it is types of controlling. Each, e- each company has its own set of control procedures and key performance indicators. The 20% of areas which are to be majorly focused upon to bring the maximized output. Different types of controls which could be practiced in different functional areas within organization are production control. Amount produced can be compared to quantity generated in the previous fiscal years as a significant indication for measuring and monitoring problems. Another component to evaluate and monitor manufacturing process in an organization is the quantity of the product and more crucially the efficiency and effectiveness of the product. For instance, per unit cost may have been lower in the PY but have risen in the CY. Second, marketing control. The number of sales is an essential measure to compare marketing efforts. For example, if the amount of sales in the previous year was X and it is X plus 1 in the current year, it implies greater marketing management and vice versa. Other factors to consider are brand awareness and market share value, increasing or decreasing. The third one is human resource control, monitoring absence, they are which implies employees are missing work and vanishing without notice might be an indication to examine HR control. Increased absenteeism indicates a need to monitor and bring control so that it can go down Dissatisfaction with the job, co-workers, and working hours are so are one of, are some of the factors. Employees are asked to participate in satisfaction surveys in which they are asked to provide comments in order to determine the level of satisfaction. A high, moderate, or satisfactory degree of satisfaction may be sufficient, but if they are dissatisfied, remedial action is necessary. The cost of manpower is the expense expended on each person, such as training costs and so on. It must be determined if costs are rising, the business will be able to get sufficient benefits from the employee. The fourth type is financial control. This is the most important element of controlling and monitoring the organization's performance and taking remedial action. It may be done by analyzing a company's financial statements, such as the P&L accounts and the balance sheet. Another key indication of financial control is the ratio analysis approach, which is used to the data on the financial statements. Under financial state control, there are types of ratios. The first type is profitability ratio. It suggests the ability of an organization of getting maximum return on investment. An ideal ratio is greater than 10. The second is solvency or liquidity ratios. It suggests the ability of an organization to liquefy its asset as and when the need arises. The third is activity ratio. The ratio helps measure the ability of an organization to convert its inventory into sales. And the last is leverage ratios. It suggests the amount of debt a company is holding of a given point of time. It should not be too high. All these ratios are calculated to judge, analyze, assess, understand a company's financial performance as well as production, marketing, and human resource performance, and to check control criteria to combat and remedy negative deviations as well as to assess positive variance. Following this, Sir gave an example. Assuming he and ma'am both make a sale of $100, but in his instance, the cost is 95 and the profit is 5, while madam earns a profit of 10 and the cost of production is 90. This example was given to us just us this example was given to us for assisting us in grasping what profitability ratios are on a basic level. Despite the fact that the number of sales is the same, one makes a profit of 5% and the other makes a profit of 10%. The explanation might be because sir could have taken a loan or may have been in a different state and had to pay a different tax on expenditures. It demonstrates how productively the assets are utilized. The there must be a balance sheet. For example, if we have to make 10 out of it, but my returns, but sir's return suddenly climbs to 35, this may not be a healthy overutilize our asset. When we place too much emphasis on investments, or we may encounter difficulties. This is what happened in the Bhopal gas tragedy, which was primarily caused by an which was primarily caused due to squeezing of assets and negating the deteriorating machine values. Thank you.
So I think overall, both Anas and just a minute, let me- both Anas and Ahmad, in terms of content, the coverage of the content, they did a good job. And just a few explanations which I would like to add. Like Anas talked about those four L's, which Zareen ma'am suggested in the context of personal controls. How can we assess how we are progressing towards our own goal? Hmm? And how can we have lead a balanced life, or are we leading a balanced life? And there, in that context, so in that context, this concept of 4L, which Stephen Covey proposed, that is live, love, learn, and leave a legacy behind. So, live refers to the physical and the financial aspect, isn't it? So, living life comfortably involves a healthy life. We are in the good state of health, and also we have sufficient financial wherewithal so that we live comfortably and those who depend on us, they live comfortably. Isn't it? So, the first element of a healthy life is that we should have sufficient uh, resources to live comfortably. And that means we must have an earning potential. We should acquire right kind of skills so that we lead a healthy life, isn't it? Then second thing is the uh, intellectual dimension of our personality, which is learning part, isn't it? Each day we must be better off in terms of intellectual level, and that is what the theory, that is what this aspect suggests, that we must spend some time on our uh, you know intellectual growth and development. And the third dimension was love. We all have this basic need to love others and get love in return, and that means that cultivating relationships, both personal and professional, especially personal. In fact, there is a saying कि असली हीरो वो है जिसे घर वाले हीरो समझे. So uh, are we really in sync with our other family members? And that includes elders, that includes siblings, and that includes youngers who would be there at some stage naturally, children, for example. So that is the love part. And finally, we are a, a being who has to think beyond his or her nose, isn't it? So we cannot, a mature or a well-rounded person is one who uh, gives back more to life than what he has got from life, isn't it? So that is the idea of the leaving the legacy behind. So this was something which I thought I'll explain, because it's a very catchy uh, way in which Stephen Covey has proposed these ideas. That is, live, learn, love, and leave a legacy behind. Now, there were some other aspects also when you talked about the example which I shared with you. Uh, that is profit before interest. I was talking about profitability ratios, and I gave that example of making sale. Now, in that context, I was making a reference to the gross profits and net profits. And there I mentioned about this profits before interest and taxes and profits after interest and taxes. So generally, profit when we have not accounted for interest and taxes, that is considered gross profit. And when we have accounted for the interest and taxes, then it is called the net profit that we get. There may be other aspects also which you must have studied in your accounting paper, and you will study more of it in your financial management paper in the second semester. So I'm not going into the details, but my core idea was that you should be able to appreciate that if both of us make a sale of 100 rupees, the difference could be in terms of For example, my cost may be high, or I may be incurring, because what is profit? Profit is revenue minus cost, isn't it? So we have made the same revenue, but our cost is different. Maybe that way our products, for example, if she is into sale of applique product, maybe the scope of earning profit is more in that activity, isn't it? So that is the point, that our profitability could be different, especially if our costs compositions are different. Then you have already talked about other ratios also, like activity ratios. How quickly you are able to, ultimately every business has a cycle, and how that cycle operates. We purchase raw material, we process that good, and we have work in progress inventory. Then finally it gets converted into the final products. Those products are sold in the market, they may be sold on credit, and then there is a realization of the revenue. And finally, again, we use that proceeds from that sale for buying more raw material. So that is our operating cycle. For some businesses, this may be different. For some businesses, I mean, every business will have a different operating cycle. For example, if let us say Zareen ma'am is into making of applique products, she will buy the raw material, she will hand it over to some of the contract worker who is in her contact. She will maybe take 2 days, 3 days to make that item, and then that item will be packed, and then maybe she will wait for a exhibition, sale exhibition, which she would hold, and there it would be sold. So finally, the whole cycle may take, let us say, 3 days, 3 months, 4 months, isn't it? But for some products, this is a very different thing. For example, one of our colleague, Dr. Waleed, he went to Bhel, and there the operating cycle is more than 3 years, because they are making transformers. But the point is, whatever is the industry standard, if we are able to exceed that, and we are able to quickly convert our raw material into finished sale and earning revenue out of it. So we have to analyze all those days which we spent on these activities which I just now listed, which are common sense activities. We buy raw material, we convert it into finished products, then we have our stock with us, inventory, what we call. We make an effort to sell that inventory. So my point is that start analyzing businesses on these accounts, and that way we will develop a specific understanding of these concepts. That was my core point. So, Anas, a few suggestions. You are overall, you maintained a formal demeanor, and but both of you could be slightly cheerful when you make a presentation. So both of you were very grim-faced all through, which may not be like now you are smiling. That is a good demeanor to maintain while making a presentation. And some unconscious gestures which we do, like for example, Anas, you are in the habit of rubbing your face when you make a presentation, and sometimes when it blocks our mouth, then it is even more problematic, isn't it? Because it may, you know, the quality of voice may be affected because of that, and we may not be able to connect better with the audience. So take care of this. And Hamad, for you, I think the key suggestion is, it is good that we prepare the written text because it helps, but don't depend on it too heavily when you are making a presentation. because unless we connect with the audience, and somehow when we read out, the connect is missing, isn't it? And especially it gets in a way very monotonous also. Like for example, if you say CY and PY, now how far it is good, isn't it? How much people will be able to understand what this CY and PY stands for. So use previous year, current year. That sounds better when we speak, isn't it? We economize when we write, isn't it? Acronyms. But while speaking, such acronyms may reduce the clarity of delivery because the audience may be confused. What does that mean? So that's all I think. Zareen ma'am, if you have something to add, then both to as a feedback to this and in terms of adding to the content which we have discussed.
Thank you, sir. I can add few more points to the discussion we had yesterday, um, like related to the financial controls. Uh, in um in financial controls, we will be discussing few more points, and then we can also look at the budgeting process very quickly, and also we can discuss about auditing, just a few advantages of auditing and why it happens, because it is again a way to monitor, to control the processes in organization. So just to explain little more about the financial controls, we can again have a look at the financial statements. Now we can see what is the basic motive, what is the basic objective of the financial statements, or maybe what are the major financial conditions which are reflected in the financial statements about the organization. So first could be the liquidity. We discussed that how fast, how quickly the ability of an organization to convert its assets into, let's say, cash, right? And why? To order In order to meet the current needs or the financial needs and obligations of the organization. So it is called liquidity. So this is one condition which is reflected in the financial statement. Other condition which could be reflected in the financial statement is the general financial condition of the organization, in which they can see the long term balance between the debt and equity. Okay, so when the assets which are left after the liabilities are deducted. So general financial condition, how well the organization is performing in generally, not specifically, but generally how it is performing, how it is financial condition related to the debt, to the liabilities, to the assets. So it is reflected in the financial statement. Then the third condition which is reflected in the financial statement is the profitability of the organization. So, okay, the financial statements also reflect the profitability of the organization. That is the what is the ability of the organization to earn profits steadily and over a period of time, over an extended period of time. Uh, how able the organization is to earn profits. Now, these financial statements, like we all know, are used widely by managers, by shareholders, and financial institutions for and also by the investment analysts, because they would be seeing the condition of the organization before making an investment, and and it is also checked by the stakeholders, by the shareholders or by the stakeholders before they invest in the organization, so that they can evaluate the organization's performance and its financial health, you may say. So and managers, with the help of financial statement, they can very easily they can compare the organization's um, organizations' performance, organizations' financial statements, and with that of the past statements, with that of the past financial condition of the organization, and they can also compare with that of the competitors' financial statements. And of course, they can comment, they can observe how well this organization X is maybe performing with respect to the past years, or maybe with respect to its competitors, right? And it is also important to see what financial statements do not reflect, right? So we mentioned that financial statements reflect liquidity, they reflect overall general financial condition of the organization, it reflects the profitability of the organization, but at the same time it may lack also in reflecting something very important. Any idea? Any idea what a financial statement may not be able to reflect? Any like one of the relevant information which it is not able to reflect?
Ma'am, financial statements usually deal in those transactions which are monetary in terms. So the work environment, how the work environment is basically in an organization, they might not be able to reflect that.
Sorry, I did not. Last line, could you please repeat, Palaksh?
Ma'am, the work environment in an organization, they might
Okay.
not be able to reflect
Oh,
that.
yes, very good. Okay. So, like you said, you are correct. The work environment, it is not able to reflect. Maybe we can also say that, for example, if there's a technological breakthrough, or if there is a recent scientific breakthrough, okay. So these kind of breakthrough are not very often, are not often shown in the financial statements. For example, like you mentioned about the organization atmosphere, so we can say that the um, with respect to what, the organization environment, with respect to maybe you are talking about the employees. Are you talking about the employees, Palaksh?
Yes, ma'am, the employees in general.
Okay, okay. So you're talking about the employees, okay. Mm-hmm. The condition inside the organization, what is actually going inside the organization, which may lead to the downfall, because if the employees are not satisfied, okay, very good point. At the same time, organization environment could also be studied with respect to the consumer, with respect to the customer, right? So many a times consumers taste are shifting, many times they are maybe shifting to other products, to maybe to their competitors, which are not reflected in the financial statements, which may be reflected maybe at once, maybe suddenly. So with respect to employees also, Palak, you are correct, and also with respect to consumers also, we can see that in case their tastes are changing, in case their preferences are shifting, that is also not reflected in the financial statements. So this is something which is not monetary, right? Which is something intangible. So the financial statement is not able to reflect these aspects, which are also very important for for evaluating the performance of any organization. I hope you acknowledge this part. Another financial statement we discussed yesterday, uh, we discussed very short yesterday, is the balance sheet. So, what is the balance sheet? What is a how would you define a balance sheet? Um, okay, okay. So it describes maybe the assets, like you said, assets, liabilities, and also it may exhibit the net worth of the organization. Okay, so the message of a balance sheet, if we see that what message a balance sheet gives, it could be that here's how the organization is functioning financially at this particular time. So that is what a balance sheet would indicate. Like you said, it shows liabilities, it shows assets, it shows net worth. Then of course liabilities also could be current liabilities, could be long term liabilities. So what are current liabilities? Just examples of current liabilities. Hmm. So hmm, so you mean liabilities could be current liabilities could be debts, right? Such as you just said, hmm, which are to be paid in the short term. For example, accounts which are payable, maybe the short term loans, maybe the taxes which are left unpaid. So these could be the your current liabilities. And what do you mean? And what could be the long term liabilities?
Bank loans.
Okay, bank loans, yes. Maybe we can call it yes, bank loans, also called as mortgages, people mortgage, and
Long-term borrowings,
long term.
shareholders fund.
Yes, shareholders. So maybe the in
Debentures.
okay, okay. So in the form of bonds, also there are long term liabilities. Good. So this is which is what is reflected in the balance sheet. Then another financial statement is the income statement. So what does income statement describe specifically?
And the income of the business which it has earned in an year or so, in an accounting year.
Right. For example, we mentioned that balance sheet it describes the company's financial condition at a given point of time. At a given point of time, where but the income statement it summarizes the financial condition of a company uh, over a given interval of time. Okay, so this is basic difference. So income statement could reflect that about the organization, that this is the amount of money which has been made in over a given period of time. Okay, not at not at this time, but at the given period of time. So this is your basically the income statement. And what does income statement carries? What could be the figures related to what?
Ma'am, commission earned
Okay,
and
commission earned.
in
Okay, revenues.
Sources of income.
Hmm? Okay, I'm sorry, Adil. Okay. Okay, okay, so that is our income. Okay. And all okay. It could also show the cost of goods which are sold. It could also show the taxes, could also show the interest earned. So these all come in our income statement. Okay. So okay, we have 6 more minutes to go. So um we can discuss another financial control, which is budgeting. Okay, so budget also we can discuss very quickly in the time. So as we all know that budget is something which is generally received when managers generally receive top management's kind of a forecast, economic forecast, and which carries some sales and some profit objectives for the coming year. So that is the budget, and it also carries many a times how it could be completed, how the budget could be met. Okay, so there are these kind of we can say kind of timetable which is given, that how this given budget could be met. Now, budget could be two ways. One could be, see, in few organizations there is the preference is given to the top down budgeting, where the budgets are prepared by the top managers, and as the name is suggesting, top down, we have discussed it in various related to various aspects. So budgets are prepared by the top managers, and with little, or we can say with no consultation with the lower level managers. And most companies, they prefer the uh, budgeting top down budgeting, because they think that they know better. They can implement it in a better way if they are able to form the budget, the top manager. And they think that maybe they are they understand the condition of the organization better. Okay, and then once the top managers set budget, they may send the budget to maybe to the higher level. If there is any other higher level managers than them, they can send the budget to them for the approval. Then there is also the bottom up budgeting. Bottom up budgeting is when the lower level managers participate in the process of budgeting, and they also have a say, they also have their advice, they also have their consultation is also taken by the top management. Now, the bottom up budgeting also has a number of advantages. So any advantage you could mention, which is usually there in the bottom up uh, processes?
Ma'am, decentralization is effective in those terms because when the bottom to top approach, when the people at the bottom actually get to decide, then they can decide the policies according to them, which are often neglected by the high level management.
Okay, you're right. So the first advantage is that these low level managers, or the low level departmental heads, we can say, they have a more intimate view. They have a more intimate view of their needs than the top level managers do, and they can also understand the kind of expenditure and the needs of them, of what is required better than the top level managers must be imposing on them. So it is important in that way also. And also, like we have always discussed, that when the low level managers are involved in any process, or when anybody is involved in any process, then the the feeling of ownership is high, right? So in that sense also, the managers, the low level departmental heads or the lower level managers, they are more strongly motivated to accept, because then, since it is their proposal, it is something which they are proposing, so they are strongly motivated to accept and also meet the budgets which are being formed, which are being given the shape. So, th- again, we are discussing this in the light of the controlling. So, this is also a method to monitor, to control the financial aspect of the organization. We are left with okay, since the time is short. Um, we can discuss auditing also quickly in the next 1 or 2 minutes. We can quickly go through auditing. Can anybody tell me what auditing basically is? The definition of auditing? Why do we do auditing? What is the purpose of it? Basically, auditing is done to detect fraud, detect something
And basically, an
inappropriate.
inspection done.
Ji?
An inspection done to take all the frauds and malpractices, whatever.
If there is any inappropriate activities going on or a fraud is going on, so that could be detected through auditing, right? Now, auditing could be external, auditing is also internal. So what has happened in external auditing? In the external auditing, it is again a verification process which involves people from outside the organization, which are outside the organization. The external auditing is done because they uh, they employ, or maybe they hire any chartered accountant or any firm who may check all the details, the financial statements of the organization, and check if any fraud has happened or any inappropriate activity has happened. And external auditing plays a very significant role because it encourages the people, or it also sometimes maybe forces employee to be honest, not only in the preparation of the statements, like preparation of the statements he may manipulate, but also in the actual operation of the organization, because internal auditing he may handle, but external auditing, when it's a completely new people, completely new organization, then there are more chances that the fraud is being detected. So it is another way to control, to monitor the financial activities of the organization, how well it is happening. Similarly, we have internal auditing. In internal auditing, it is carried out by the members of the organization. Okay, it is carried out by the members of the organization, and it aims to provide a reasonable assurance that the assets of the organizations are being utilized for uh, uh, for uh, um, for for the right purposes. Okay, so they are ensuring themselves through their own people, and their financial statements are checked, and their reliability and their accuracy is being checked as far as some inappropriate or fraud is concerned. Okay, so since we are running short of time, so these are again some of the financial controls, financial statements, then budgeting and auditing, which is carried out in organization to understand how well the organization is performing, and the activities, financial activities of the organization could be controlled, could be monitored in this light. So, sir, I think we are running out of time.
Mani, that's all. I think we have covered quite a bit. So we call it a day. Oh, thank you.
Thank you all. Thank you,
Thank
sir.
you, sir. Thank you, ma'am.
Thank you, ma'am. Thank you,
Thank
sir.
you, ma'am. Thank you.
Thank you, sir. Thank you, ma'am.
Thank you, ma'am.
Thank you, sir. Thank you, ma'am.